How safe are bonds and how do I understand safety? In general, from a safety perspective, if you look at all the assets, it's first fixed deposits up to the DICGC limit, then bonds, and then assets like mutual funds, stocks, etc. But it is also important to note that bonds is much closer to fixed deposits in terms of safety than they are as close to risk in terms of mutual funds. The first parameter for you to understand is ratings. This might sound complex, but let's simplify it for you. Think about ratings like grades in schools. That's the first level. A, B, and C, right? A is considered generally safe, B is considered generally risky, C is very risky. And A-rated companies, bonds, probability of a default is somewhere around 0.1%. What that means is roughly 1 in 1,000 bonds or companies may default. A B-rated bonds probability is around 1.5%, which means 1.5 to 2 out of 100 bonds or companies can default. In C-rated, it increases at as high as 15%, right? Like 15 out of 100 bonds can default. Now, within A, there are 3 filters. Look at it very vertically, right? You have A, AA, and AAA. The more the letters, the bigger the companies. Let's put it that way. A-rated companies are typically private-rated companies which are doing really well. In AA, you'll see a lot of AA-rated companies which are typically like public limited companies, right? Like Shriram, Muthoot, etc. AAA-rated companies are big conglomerates like Tata, NTPC, and more so. In A and AA, sometimes you will also see ratings like plus and minus. A plus, A minus, AA plus, AA minus. Minus here doesn't mean anything negative about the company, right? It just means that in the relative ranking within A, an A plus is a slightly bigger company and more closer to a AA than A minus, right? So that is what the significance of a plus and minus is. A company's motivation is always to move up the rating ladder, right? From B to A to AA to AAA. Why do companies want it? Because the more you move up the ladder, the lower the rate of interest they can raise capital at. A classification like plus and minus also helps them move forward without having to jump to AA, which typically might take somewhere around 3 to 5 years. And that's the benefit of having a minus and plus classification. The second important parameter you should think about is the credit rating agency, because who's giving these ratings, right? In India, typically there are around 17 to 20 credit rating agencies, but the top 4 to 5 have the best rating methodology, which is tested by time. Few of the names that you should always look out for are CRISIL, ICRA, India Ratings, and an audit company called CARE. It's like a rating from these companies ensures that the due diligence is done on a higher level. The third parameter is the nature of the bond. Bonds come in many ways. You will hear words like senior, secured, unsecured, etc., right? But before we get into it, let's take a small example. If you're buying a big home loan, right? The bank will say, you have a great CIBIL score, so I'll give you a loan at a lesser interest rate, but still I need some collateral just in case something happens. And this is similar to what happens in bonds, right? There are also some loans like personal loans where there is no collateral that is taken from you and typically carry a higher risk to the issuer, right? Bonds also have a similar mechanism. A secured bond has an underlying asset or collateral attached to the bond, right? Unsecured ones have no underlying collateral. So it's always better and wiser to choose bonds which are secured in nature. Senior secured bonds are one step above only secured, right? Senior secured means that if the company defaults, that 0.1% probability that we were talking about, or if the company goes to bankruptcy, the first legal obligation of the company after selling its assets is to pay the senior secured bondholder. They have the first right and hence senior. This has got nothing to do with the age of the investor, right? So one of the short ways of investing in bonds is to invest in A-rated, at least A-rated bonds, senior secured bonds rated by the best credit rating agencies. But is that it? No. The most important point, and this is from a personal experience that I've understood, is the tenure of a bond. When we talk about risk, the risk to a bond is of the company, like let's say going bankrupt. A good rating ensures that the chances are very low, like the 0.1% we were talking about. But ratings cannot factor in unknown events like a potential COVID. I hope that never happens again. Or a war that is coming that might or might not impact these companies, right? And Unpredictability increases as you increase the tenure. Now, as a smart investor, you can use this to your advantage. While FDs are best for long-term predictable returns, you can use bonds for safe and short-term high returns that are fixed and not linked to the markets. An A-rated bond for 1 year, typically around 1 year, carries the same risk or safety as of a AA-rated bond for 2 years and a AAA-rated bond for 3 years, right? A for 1 is same as AA for 2 is same as AAA for 3. If you step back, it's like the ratings are an indicator of the strength of the company, and strength means the ability to mitigate risks, known and unknown. Now, a AAA-rated company can give you somewhere around 8% returns. A AA might give you somewhere around 9 to 10% returns. An A-rated company can give you around 11 to 12% returns. By choosing bonds which are A-rated, typically under 1 to 1.5 years, you have the same safety or risk as a AAA-rated bond for 3 to 4 years, right? And once the maturity happens, you reinvest that into another short-term bond. And as an investor, if you take care of these 4 things, the rating, tenure, credit rating agencies, and the type of bond, right? Secured, unsecured, etc. You know almost everything to take your first step into bonds. This brings us to an end of the second video of this series. I hope you enjoyed it.